Greetings, scholars! That picture right there is you, by the way. Welcome to episode 1, Slopes and Channeling. So before we dive into the calculus, let's go over some stock market basics. Obviously, you're watching this video because you want to make money, and the point of the stock market is to make as much money as possible. So in general, you want to buy low and sell high. Let's look at Apple stock. You want to buy it here and sell it here. Easy, right? Well, the obvious problem is that none of us can predict the future. Or can we? No. But we can approximate it, and we can also lower the risk as much as possible. Imagine you went to a casino, and I told you you'd only be right 50% of the time. But I also told you that when you were right, you would win twice as much as when you were wrong. Although it does require some sort of risk, we can see that if this promise was kept, it would be a good strategy. And that's basically the idea behind trading. No one is going to be right 100% of the time, but you can make significant profits through risk management. So how do we approximate the future? Well, in trading and in calculus, we use what's called a best fit line. Let's look at this price fluctuation. Overall, it's very chaotic, but in general, it follows this line. The magic here is that if this line is correct, we can project this into the future and predict what kind of profits we can expect. So you may want to buy here and sell here. Now you've made some money. At this point, you might be thinking, you haven't even talked about calculus at all. But I actually have. Calculus is simply the study of rates of change. If you've ever been in a boring class, looked up at the clock to see how fast the second hand is moving, and then estimated how long it would take for the rest of the class, then you have studied calculus. Let's look at the stock chart again and see why our trade was so profitable. It's because the best fit line was sloped upwards. Obviously, if our slope was negative, you would have lost money. And that's why slopes are so important. You should care about slopes because higher slopes means higher profits. And in calculus, a slope is defined as a change in the rise over a change in the run. But what is rise and run? The easiest way to calculate rise and run is to pick 2 points on the line and find the difference. And in math world, we call this a secant line. The difference between the 2 price values is the rise, and the difference between the 2 time values is the run. Let's try to improve our profits a little bit. We'll look at Apple stock again. If we strictly followed the trend line, we'd buy here and sell here, which is pretty good, but would have been even better to buy here and sell here. You might be thinking, hindsight's 2020, you could have never made that call if you were really trading. But actually, you could have found it by using support and resistance lines. The resistance lines are created by connecting the highs, and the support lines are made by connecting the lows. These support and resistance lines can be used to form channels and wedges. A channel is formed when the support and the resistance lines are relatively parallel to each other, and a wedge is formed when they're not parallel. So how does this connect to calculus? Well, you can't tell if 2 lines are parallel unless you can calculate the slope. Once you calculate the slope, you can find if your trend is getting stronger, like in this example, or weaker, like in this example. If the support has a higher slope than the resistance, it usually means the trend is weakening, and you should probably avoid buying the stock. But if the support has a lower slope than the resistance, it means that the trend is strengthening, and you should probably buy. Let's end by talking about some nerdy math definitions. In order to understand the future episodes, you need to understand how functions are defined. And you might have noticed that a stock chart is just a function chart. Changing time causes the price to change, and so time is the independent variable. Now you may think, maybe price causes time to change. How would you even know? Let's look at a graph. These points have the same price, but different dates. Let me show you what would happen if price was actually the independent variable. Look at those same 2 points. If I asked you how price causes time to change, you'd look at these points and be extremely confused. Because one input is leading to 2 outputs. Imagine I own a factory that makes soccer balls, and I put the same components, in the same order, in the same process, and get 2 different balls. That would be very strange, and I'd probably start firing people. The predictability of the outputs based on the inputs is what makes it useful to traders as well as mathematicians. And so when you're trading, don't try to control the market. Understand that it changes with time. So just to recap on this lesson, you're going to buy low and sell high to make profits. You're going to use best fit lines to approximate chaotic stocks. The higher the slope means the higher the profits. Using support and resistance lines can show you if the trend is weakening or strengthening. And most importantly, calculus is just a study of rates of change.
Basically, we've got this move up and then it pulls back a little and then it goes further along. Well, normally what you do is you pull a line from the low, you'll go through a balance point, which is basically an area of least resistance around the 50% area, and that gives you your target, and you can see we came in pretty much on time. On target, we came on target. Now, the point is that you can measure this, any time, well, I use time expansion tool, anything that just measures, you can measure this through the area, and look, there's right on the timing. Timing was spot on. Another way of doing it is you can count the candles before and count the candles after. Okay. And that gives you timing, which is great. If you do options, and you're looking for when price will come in at a certain time, you can do well on your option trading just by using these two tools once you understand what a balance point is, But that's well and good if everything being equal, and that's why I've chosen this example, because this example, you can see that the length of the candles are pretty equal, okay? And that's why the timing came in on target. Volatility will affect timing, just like I said, So you can see here we've got a bit of an issue. If you look at the length of these bars here, volatility has increased here, certainly compared to those that have been on the left-hand side of the chart. So we've had an increase in volatility here. The second thing that you'll notice here is that the target price has exceeded the target line. Because it's exceeded, because price exceeded the target line before it reacted, that implies also that volatility was high. So if I use my cycle tool again, you'll see that where are we going? We're going from here to here. Even if you took it from here, but it's actually this one here, I would say. Well, let's take it to the doji. Either way, it doesn't matter, because you can see that timing was out. The timing was out. So if you look at this and wonder why has it come in early, basically as volatility increases, then the timing will be less. By the same token, if the volatility is lessened, then timing will take longer to come in. So what you have to realize is that the first half, right, all of this data here, determines the rules for what happens after. If after the target price volatility increases, then price will come in earlier. Consequently, if volatility decreases, obviously if we had a lot of little small candles, then timing will come in later. If the volatility after this point here is approximately the same, then the timing will be absolutely spot on. Okay, so just to reiterate, an increase in volatility means that your targets will come in sooner. A decrease in volatility will mean that your targets come in later. Okay, so I found an example here where we've had this swing up, price pulls down, and it kind of makes its way up again. This thing about targeting, on this swing down here, we've got a clear balance point between here. It's actually a zigzag, and you can see that this little high can target this one halfway through there. So what you want to do is pull through that area, which would be there, approximately there. Yeah, good. So basically, you can expect, all things being equal, the price will come up to that line, okay? And then as price is making its move through here, we've actually got a zigzag here. It's a little bit messy. I don't know if you can probably make that out. But you've got this high here, targeting this low here, and we've got a bit of a bar split, so that would be the balance point of this move up. So then you can just take your price retracement and run your 50% through this area. There, and there. And there you go, see? And that gives you a kind of confluence up there, yeah? So this can help confirm this line or this target, by figuring out where the balance point is in this move, can confirm the target here. Okay. And you'll notice that the timing is out on here. Well, I'm not even going to bother drawing it, but you can see why it's out, because look at what happened here, and then look how slowly this is how slowly this happened. Look at the length of these candles compared to these ones. Price was much faster on this side. And so because there was a change in volatility, price should have come in about here, shouldn't it? But clearly it didn't. It came in way up here, because of the change in volatility. So this example shows how you can use a target line and confirm it with identifying a balance point in the making as price gets closer to your target line, And basically once you've identified this, probably when price comes back here, you'd be thinking, oh well, this looks like it's good to go, and you could profit. You could even enter a trade there, quite comfortably, or if you've identified a balance point there, you know that it's going to terminate down here, and so you could be looking to do targets down here, to enter down here as well. Now there's kind of two ways that you can measure these things. One's the mathematical approach, and one's the geometric approach. Geometric approach is where you pull a line through the balance point. Okay, so in this situation, we can do it again. Look, you'd pull a line through the balance point from a previous high down there, and you'd expect price to come down to it. Let's see what happens. Bang, it hit it. Look at that. You can see it even paused on it, Now, the mathematical approach would be where you take your 50% tool and you pull it from the previous high, and you run it through the 50% of the swing up, which is there. Which is there. And it's always good to do two of these. It's always to do geometric and mathematical tool. And there you go. You can see price came straight down to it. No problem. I mean, it exceeded it, but because the bias has changed in the market, which is a different thing. But if we're just looking at volatility and looking at measuring these moves from a geometric point of view and also from a mathematical point of view, you can clearly see that both targets came in. All right. Now, if you do it from the mathematical point of view, which is using a tool like this, you can use your fib tool and just delete all the other settings and keep the 50%. If you do it from the mathematical point of view like this, then you don't need to worry about volatility or changes in the market, okay? Because this will come in usually for you, all things being equal. The geometric method of measuring these moves, if volatility changes, and you expect it to kind of come in at a certain time, often it might not do, but it might have done on the mathematical approach. If I give you an example, it's hard to kind of see, but if you imagine that this took longer to reach this level, if it took longer, like say it came in, look, let me show you. Say it came in here, right here. We're still talking about 1, 2, 3, 4. 1, 2, 3, 4 is your target. That's interesting. Anyway, let's say it came in here. If you were waiting for price to hit this line, you would have missed out. You would have missed out on the move, and then maybe it went back up and made new highs. Whereas if you used this tool, then it's fine. Your target would have been hit. Job done. And you'll see that quite often. So if you are going to use this approach in your analysis, get used to using them both, geometric and mathematical.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up, only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available, in this way ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analysing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analysing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages. Our next video will focus on how to trade using moving averages. Don't forget to subscribe to our YouTube channel and visit our blog for additional information. If you have any questions, please let us know in the comments section and we will get back to you. We wish you successful trading with Trading 212.